Okay, welcome to the Investment and Benefits meeting today on February 10th. Welcome, everyone. Did everyone have a chance to review the minutes from our last meeting? And if so, any questions or concerns?
Maybe one. It shows my name up there, but I was actually absent from that last meeting. I don't know if that's what that's referring to at the top there. If that
Yeah,
means we're in attendance or just on the committee. I wasn't sure.
I would think that would mean you're in attendance, but.
That's usually what it means, but I was actually absent from that meeting.
Okay. We can make that correction. Okay, anything else on the minutes?
Kelly, did you say you were gone last meeting?
I was, under home.
Oh, okay. Okay.
Okay, so if there's nothing else, we'll move on to Soltis.
I'll move to approve the minutes.
Oh, thank you, Dave. I have a motion, second?
Second.
Okay, we have a motion and a second to approve the minutes. Everyone in favor, say aye.
Aye.
Motion will pass 6-0. Thanks. Okay, for the minutes or the, the agenda for today, is there anything on here that anyone has any questions about or needs to add anything or make any changes? Are we good to go with this agenda? So everything you got on here that you wanted? Yeah. Okay, that's kind of where I was going with that. I wanted to make sure we got everything. All right. No, it's a thank you. All right, so, Soltis, go ahead and give us your report.
Okay, thank you for, as always, having us here and grateful for the chance to be here. We'll start off with some fiduciary governance items. I know we spent a little bit of time on the Secure Act in our last meeting. It was in that last meeting, it was still in proposal form at the legislature back in Washington, D.C., and of course that's been passed. So we'll take a few minutes there today. We'll then, of course, do an investment review of the investment menu and go through that. I think one of the follow-up items from our last meeting was a discussion of the goal maker portfolios, and we've come to kind of go through that with you today. And then we'll turn the time over to Prudential and Kelly and go through a number of things. I know cybersecurity was one of the follow-up items from that last meeting, and so we've got that on the agenda and those things for them to cover along with the other. I think, Dave, a couple of the items that you brought up were, I think that's where they kind of fall on the agenda. And then, of course, we'll finish with just a review of both the education and participant support provided for 2019 and then what's kind of proposed, what we're looking at for the 2020 calendar. So the first place I'll go is on page 8. There's 2 business calendars, and our apologies in the conversion to PDF, somehow the dates got lost. So the first calendar on page 8 is the calendar from 2019. And I think just to take a minute or two and report on a few things that are there. One, of course, we continue to, as we always do, keep updated the fiduciary vault and documentation for the plan and have that updated with all of your appropriate notices and things that went out for 2019. So that's up to speed and done. I know we spent some time last year in a couple of different meetings on some of the recent court cases, particularly the NYU case, and studying and looking at those. We went through and looked at the plan design and kind of benchmarking of your plan versus other government entities and had some discussion around that. And then, of course, there's a couple of big things last year. One was the merge of the 401A plan into the 401K, and I think that went about as smoothly as we could have hoped for. I don't know if the committee shares the same, but we didn't get too many. We had a few questions here and there, I think, from participants as we met, but most participants understood the consolidation and lowering of fees is a pretty good message. So, and then, of course, we had the implementation of the collective investments that Soltis had negotiated and had available, and we appreciate Prudential. Every one of these platforms we have to work with, and they have to be willing to put those new collectives on there. And those were put in there right down there below under investment reviews. You know, we've got that. We'll show you the numbers here in a little bit, but the investment expense, those collectives on your plan, took the weighted expense from about 0.54% down to about 0.47, which translates to about 130,000 of lower expenses and investment expenses to your participants that was resulted last year from that change. So, and then we'll go through this today. At the end of December, of course, we have both active and passive managers in the plan. For those active managers that are in there, we expect to see return from them that's above and beyond their passive benchmarks. Right now, the average excess return for your managers in your plan is about 0.89%. And then right now, the average percent of the time that the manager is beating that benchmark is an average about 83%. So we hope that having good low fees and also having good performing managers is obviously value that's driving to the employees and something that we watch and measure very closely.
So those numbers are after deduction of the fees, is that right?
Yep.
Those are the net.
They are. They're net. Okay. Any questions on any of those items from last year? It was a busy year with lots going on. Like I said, 401A merger and the CIT implementation was a lot to get through last year, but there were some, obviously they're making a big impact on the plan and some other things as well.
I had one question as to whether the NAGDA documents had been saved into the fiduciary vault, the NAGDA training.
The NAGDA training, I will circle with Tucker. If we received them, I don't recall seeing them come through.
That was an action item from last meeting to, for the county to send to Soltis those documents so they could be put in the fiduciary vault.
So let me do this. I'll follow with Tucker. I'm just trying to recall it, but you know, I get lots of emails and I'm probably guilty of not keeping track of every single one. But I can double check with Tucker. If we have them, if you sent them to us, we would have uploaded them because that was part of this, before this meeting, as we go through from all of 2019 to make sure everything that needs to be in that vault is there.
I think Mark was gonna send those to them. I don't know if that happened or not, you know?
I'm sorry.
We were gonna send to Soltis the NAGDA, the agenda, and those who attended. And maybe you did, I don't know.
And maybe you did. I'll circle with Tucker. So. Okay, for 2020, I think, once again, we've got on the business plan, so this is on page 9, as we've kind of looked out for this next year and looking at things that we're doing. By the way, we have an education calendar too, so the reason the education's not on here is we have the calendar specific to that. We'll touch on that at the end of the meeting, at that part of the agenda. But I think from a couple of things here, one is, I want to mention a couple of things. Obviously, the Secure Act was passed at the end of the year. We're going to take some time there. We have a fiduciary training in a couple of weeks where we're going to spend significant time there, and I'm sure Kelly can help provide some update there as well. But I think one of the things that will certainly an important initiative for this year is helping to understand what that means. And as always, we know that you guys are not an ERISA governed plan. But also knowing and understanding what these, you know, what that law changes. It has some changes, and we'll go through that again today, a little bit of that. The Goal Maker Review we talked about, and we'll go through that today, I think, in talking through that. I think a couple of things which just to make sure the committee is aware of. We're excited, but we've been invited by Prudential. They have an advisory board member. They have an advisory board where they have a handful of investment firms throughout the country that they invite to sit and help kind of be advocates for clients in the retirement plan space, and they've actually invited us to be on that board. So we'll be in there in March as our first meeting, and Prudential's a great partner with, you know, we've got some Utah County, but we've got a lot of other plans as well. And anyway, I think just to make the committee aware, I think Prudential's purpose in that is to help understand from the advisors and the plans that they're on, you know, what they're doing, what they're offering, and how can they be better. So, and if there's items of discussion, we'll be updating you kind of in terms of what we see coming for Prudential, you know, as we're looking at and having some of those discussions with them. But
Tyler?
yeah.
Ralph's on the client advisory board.
Okay.
So this is gonna be really great for us, because we can, you know, keep it all within, you guys will all see the latest and greatest between
Okay.
Tyler and Ralph. So,
Awesome.
So Ralph, who's good cop, bad cop?
You're the best.
Okay. No, we appreciate it. I think some of you know, we sit on a couple of advisory boards, another one of the largest provider in the country, and it's valuable. It's valuable for us to see what's coming in terms of plans, what trends, what other really good investment firms are doing, try and make sure that we're bringing best practices to each of our clients. So, okay. I think that kind of lines out in terms of some of the things I wanted to just point out for 2020 as we go through that. Again, there's some important education things that we'll touch on as well as we get there. But any questions on either one of those calendar items?
Nope.
Okay. We can move on. If we go to page 12, we'll talk through just make sure I'm following our agenda as needed to, on the Secure Act. So on page 12 is a summary. We've done our very best to try and give you a concise summary of this new law. I guess I'd make a couple of comments. This new law is a couple years in the making. It's a big one. So, you know, it's one of the larger pieces of legislation that's been passed on retirement plans, and one that for us to be aware of. It's also, as you guys are probably more than familiar with this, sometimes our private entities are not, but there's still a fair amount of movement or fluidity that can happen with these. So as these acts get passed, there's feedback period. The DOL, the IRS will listen to feedback. They make adjustments and some of those things, and so we can talk through that. But I think for just this committee here, there's the multi-employer plans isn't a real big issue for you guys. But that's a pretty sizable change. It really impacts kind of smaller companies where they're not very big, and the cost of rolling out their own plan can be sometimes prohibitive. That allows for them greater flexibility to do that. Same with the credit limitation for small employer pension plan startups. So there's some tax credit that has been increased to encourage smaller entities to do that. This is a big one: repeal of maximum age for traditional IRA contributions. So prior to this act, if you were over the age of 70 and a half, you could not contribute to an IRA. That has been changed with this law. So if you're working and you have earned income and you want to contribute to that traditional IRA, you still can. So that's a pretty significant change in this law. Section 112 is what I would say is probably the most concerning, and not from a plan design, but kind of more from an administrative. But this is, you have to allow long-term employees that have worked more than 500 hours, but less than 1,000 to participate in a plan. So most plans exclude part-time employees. I mean, you certainly can include them, but what we've seen is most of the time, part-time employees are excluded. And what this law is doing is it's saying, hey, not that you have to include everyone, but if you have an employee that over a 3-year period is showing that they're working 500 hours or more over a 3-year period, that you've got to allow them to participate in the plan.
Ralph, don't our employees, part-time employees already participate in the 401K because we don't have Social Security
They're automatically enrolled in the 457.
and the 457? So this would
That's
have an
7
potential impact on the county.
Yeah, it could. And my concern is the differentiation between, you know, different employees and whether or not they should be enrolled in the 401K or not. And when we get to that point, my thought is everyone gets enrolled in the 401K, and whether or not they, you know, choose to utilize it or not is up to
Yeah.
the employee. But I would rather not be measuring hours and trying to determine who should be enrolled and who shouldn't. I would prefer to just, everyone's in,
Everyone.
and then they can make their own decision about
Yeah.
whether to utilize the 401K or not. So that's my thought at this time.
Okay.
I wonder what the expense is, though. I mean, we don't wanna,
It's a good
that
point.
incurs costs, so I don't know that we wanna
Yeah.
necessarily do that.
We looked into that, and they don't unless we give them another benefit, because it's their money, whether they'd be choosing to put it in or not. Does that make sense? Yeah, so it doesn't count as a URS benefit. Yeah. Can
But
you,
we'll-
you know, speak to the cost of that, you know, Kelly, or what we,
Like, so you're talking about all new employees coming in, whether they're part-time or full-time.
yeah.
You wanna know what it would cost to match? What the
No,
would be?
just to have them enrolled in the 401K without any there's not gonna be any match for those employees. Only the merited employees get met.
Well, we're paying a fee based upon numbers enrolled, so there is
So
a
you're
diff-
per
there is a
participant.
cost. Per participant cost
yeah.
we pay. That's what we pay every quarter to you.
Right, but,
So we,
but if we're enrolling more and they're contributing to the plan,
yeah,
don't
if
foresee
they're participating, that's great. We want that, but
yeah,
we
I
just
mean,
signing them
foresee
up
a
and then
change
they
from
don't,
I see what you're saying.
perspective.
then we don't want them involved.
That's a great
Automatic
point,
enrollment,
Dave.
you're enrolling in a certain amount too, right?
We need to talk about that.
So
This
if that's like an agenda item, we're more than happy in the following meeting or even before if we need to
Is
come
there an effective date
Yeah,
for
let's
this?
do,
kind
let's
of look
do.
at the eligibility, your enrollment. I mean, Kelly's, like she's hinting at, if you did want to put a match in there to encourage them, we can help you look at.
Yeah, there's not gonna
cost
be a match.
projections.
I can almost
Okay.
certainly say that.
We'll put that on our
Okay.
agenda for the bi-weekly meeting and do a little research on that, what we can, I mean, you're not a risk, so you can really do whatever you want.
Yeah.
Yeah.
But let's talk about how you wanna do that. 'Cause
Yeah.
I wanted to talk about possibly doing we had talked about how your participation's kind of going down. People don't understand that they have this security offset is in match.
Right, right,
So I kinda wanted to talk about maybe doing a re-enrollment this year.
yeah.
We have to have a, because we aren't doing contribution escalation, it might make sense for us to do a re-enrollment.
Yep.
And grab those 300 people that aren't in the plan, and put them back in the plan. So we can talk about that as well, how that works.
So it's not a risk, so this is something we could just say, well, we're not interested in doing it.
Yeah,
Without any penalties.
yes, I mean, technically, this is an ERISA requirement that says, hey, if you're an ERISA-based plan, you've got part-time employees, you have to put them in there. So, I guess, I mean, I'd probably say I'd defer to an ERISA attorney, but the Secure Act is applicable to ERISA-based plans, and its regulations and requirements, they're expected to meet.
What is the time frame on this again?
So there's parts of it that can be effective immediately. There's a time period. Some of these provisions are, hey, 2021. So that's some of the moving part right now. But for example, if companies or organizations are set to roll into these and make them available right now, most of these provisions they can put in place. The challenge is record keepers like Prudential, when they change this all of a sudden, hey, it used to be 70.5 and now it's 72. That
We can't
require,
give it away.
yeah,
We can't flip a switch and
yeah.
go, great.
So you have this time period where the providers say, hey, look, we've got to get our systems redone to adjust for these new regulations, and that's kind of that period that we're in right now. I think what you'll see is right now, over the next 6 months, you'll see a period of feedback and adjustment by the providers, and I think you'll see most providers and plans looking to put implementation in second half of the year, being ready for 2021. And I know
That's our
Kelly,
hope,
yeah.
So are there any modifications to our plan documents that we need to make because of this? Or
Yeah,
do we
so
not?
for example, if you said, hey, we are gonna put part-time in there, or they're already in
There
there,
would be a change.
then you'd have to modify your
Yeah.
plan doc language to do an amendment to the plan doc to include those provisions.
Okay, yeah, let's for sure talk about that on our next call. Okay, thanks.
So we'll put that as an action item, in just in terms of an agenda item and additional discussion we can go into on it. I'll just finish on a couple of these. That one's usually the one we get to in terms of part-time, and then the discussion tends to go there, because that's a new one. So there's a couple of others, worth mentioning. There's more on here, but penalty-free withdrawals from retirement plans for case of birth or child adoption. That's new, and that's something that I think, probably your question yet, if you guys want to make that available, you could do that. Again, it'd be amendment to the plan doc, et cetera. Increase in age for mandatory distributions, so just like it used to be 70.5, they've increased that to 72. And so you've got that additional time now that somebody can, that RMDs will not have to happen. So that's a big change as well.
Is that in our plan documents currently, or? I don't
No,
think it- I
no,
don't
because
think it is,
the
but
previous law was 70.5.
Is there any reason why we wouldn't want to do that?
I don't think
Because that gives
so.
an employee more flexibility in their
Most
retirement.
people that are taking RMDs are being forced to take them, meaning they
Right.
don't need the money, but the government wants some of the tax, so. that's why
they
it's
can
a-
always take it even if,
Right.
it's just the forced part that
Yep.
would change.
Yeah, so I don't know if I'd really see a downside, or,
Yeah.
I mean, there might be a case or two where, but for the most part, somebody that's going, hey, I'd much rather not have to start taking that money yet, I don't need it yet. So. And then, I'll mention this one too, and Kelly might be able to speak, she can probably speak more to this one, but, you guys have the lifetime income flex, option in your plan, which is an annuity type of option, and, this law actually allows those as now to become a safe harbor for the QDIA. So, today your QDIA is goal maker. In the past, the lifetime income flex was not an option to make your QDIA, which provides a safe harbor to you in terms of, hey, you've elected to default participants into an option that meets the qualified standard. So, what this change does, it allows you to say, hey, we're gonna use the lifetime or annuity type of product as our QDIA. So, which I'm sure Prudential's excited for, and I'm not sure if you have anything additional you wanna add there, Kelly.
So you have, income flex. Right now, we just use Goal Maker. We can, change it to Goal Maker with income flex, so it automatically puts people 55 and older, defaults them into a portion of their account going into a,
Yeah.
you can decide on what portion that would be, as a QDIA, just like you do, like with a match, right?
Yeah.
So if that's something you're interested in, we can, certainly delve into that again on the bi-weekly meeting, and then bring back to the committee, what the options are. But you already have Goal Maker and you already have income flex, we just have to change the way that you're doing it. So, it wouldn't cost anything, but the reason why I think it's probably not quite as, important to the committee or to Utah County is because you have Utah retirement,
Yeah.
Plan, your pension. Now, when some of the companies that I have that don't have a pension, they may start looking
Yeah.
at something like that, so they feel like they're helping their people have some lifetime income in retirement, where right now, there's really nothing. So if they're defaulted into Goal Maker, so you've got somebody defaulted in for 25 years, never did anything, they go to retire, now they'll have some money in the income stream protection piece, that they wouldn't necessarily have before they're super active. So it's really a committee's decision, but if you'd like more information on it, we can research it and bring it back.
Yeah, I think we should. My initial thought is the county may not be interested, but I'm curious if anyone else has opinions on that.
Should we just peek and see how many default investors we have? That usually makes a big
Yeah.
Would Soltis recommend that we do that?
So one of the trends that you're seeing, which we think is a good one, is is what's called a dynamic QDIA. So actually, in our spring conference, we're going to spend a fair amount of time educating our plan sponsors on this. But a dynamic QDIA is a QDIA. We think is definitely good. So every plan ought to have a designated QDIA. It protects the plan fiduciaries. It protects from participants that say, hey, I got put in the plan, I don't know what I got put into. If you're using the QDIA, it's a qualified option. A dynamic QDIA is what you can say is, hey, we default different demographics to different portfolios. So maybe for the younger employees, 20 to 40, you default them to a target date or a goal maker. When somebody that's older, say 55, you say, hey, we're going to default them to something different because maybe a target date isn't the best option for them. So we do see, you're seeing a dynamic QDIA development that I think is good. I think what we would probably say is most of the time when you look at a plan and you can make it more personal to the participants and the demographics of the plan, you're going to get better results. So I think, in looking at that, so I think this one's new, as you can see, like all of a sudden it's hey, now you can have this as your QDIA. Doing a deeper dive, and our thought would be that let's look at that. Let's make sure the QDIA you have today, Goal Maker, which is a really good QDIA. I mean, we'll tell you, we think it's one of the best options to use your QDIA. Is the lifetime income flex a way to enhance that QDIA from what you're currently doing or not?
And you have 510
Yeah.
in Goal Maker as your QDIA.
Yeah.
And there's only 217 that have chosen Goal Maker as an elective, as a term of reflection. So you definitely have more people in the Goal Maker as a default option. So it might be, and I like the idea of the dynamic, because that kind of would fall into, we would just make sure that we never defaulted anybody into QDIA unless it's 55 and older.
Yeah.
Because there is an additional fee for the
Income flex.
1%. So we want to make sure nobody was in there paying the 1%, triggered at 55.
Yeah.
So lots of things to talk about. You do have a 40% of your population enrollmaker is enrollmaker in the default status.
Okay.
That's on page 87 if you're interested.
We'll add that as an agenda item. Like I said, dynamic QDA, we're gonna have multiple kind of sessions at our conference in April that we'll talk about this trend and this development, because it's one that we think is good. But like most things, you've gotta have the record keepers, they've gotta have the ability to have their system track it and do it, so. Okay, I'll just mention real quick in terms of, because we're kind of there, fiduciary training. So we'll actually have our first fiduciary training for the year, February 28th. You guys will get an invite tomorrow morning in your inbox, just FYI at some point. But February 28th, that's a Friday. It'll be in Salt Lake City. That's the 3 hour, go from 10 to about 1:30. And then our annual fiduciary conference is April 23rd and 24th in St. George. Is that Thursday and Friday? And then I didn't list it on here, but November 7th is our third one that we've got slated for 2020. So as usual, we'll plan to have 3 fiduciary trainings that you can participate and attend as members of this committee. So again, invitations coming. You should have all got the one for the 23rd and 24th in terms of save the date. I know.
Did you realize that was BYU's graduation date?
Yes. We did. It's impossible, and we've tried all these different dates, and there's always a big conflict somewhere, and they've started changing spring breaks and all that stuff, so
What's the
we
big deal?
we do our very best.
Are you graduating?
But yeah, we did.
Well, it's been a long time coming. Give him a break.
He's been working on it. Been working on that law degree. You guys didn't know Dave's an intern.
Keep trying to pass the bar.
Okay. Anyway, just more details to come on each of those. But in terms of your calendar, if you want to put them on there, we've got them slated for those days. So, and then like I said, we'll kind of follow up on the fiduciary vault information as we go through it. So, any questions from that standpoint before we turn to the investment portion and kind of go through the investment menu?
Nope.
Let's go to page 29 then. I'll ask Bill Wallace, our Chief Investment Officer, to maybe take a few minutes on just a market outlook. We've had a interesting start to the year so far, right, Bill?
Yeah, always
Between
interesting.
coronavirus and some other things that happened. But I'll have Bill go through that, and then we've got a couple of investment options to report on with the committee as well. So.
Maybe I'll just take you to page 32 in my thing. Is it, I'm the one with the economic indicators. Which page is that on your guys'?
31.
31, okay. I'm just, my copy's off a page. So as Tyler mentions, you know, it's interesting to see how geopolitical issues can impact the markets. And those tend to be things that, for the most part, what you've heard the term the black swan event is something that really just comes out of nowhere. I think the coronavirus is a good example of that. The market initially reacted negatively, and you know, we saw the S&P go down 3 or 4% over several days, so it wasn't a huge reaction. As of right now, the market's kind of worked, at least here in the U.S., the market's worked its way back up to where it was. The concern about the coronavirus is slower growth in China. China's now the second biggest economy in the world, and what could that do to world economic growth rates? Our position currently is that we don't think it will have a dramatic effect on growth. The jury's still out, obviously, on how impactful it could be, but it would definitely reduce growth in China, but again, not enough in our minds to really impact. So as you looked at the economic indicators page I've got here, you know, growth is measured by gross domestic product in the U.S. We were up about just a little over 2% last year, so another year of positive growth. We're in the longest expansion in terms of length that we've ever had. In terms of the size of the expansion, we actually still have room to move higher because the expansion's been kind of slow and steady rather than, it's grown on average about 2% a year versus other expansions that have been in the 3 to 3.5% range. Job growth has been really fantastic. I don't know if you saw, just on Friday, the monthly jobs report came out, and jobs were up 225,000, and they've been up 2.1 million in the U.S. over the last year. So that is a sign of a continuing growing economy, and leads us to believe, and our forecast for this year is we will not have a recession in 2020. So just because the recession or the expansions lasted 10, 11 years now, that in our mind doesn't mean that there's a recession in the offing. We look at the numbers and the growth seems to be there. So we have a positive outlook for the economy, particularly in the U.S., a positive outlook for growth, and that leads us to have a fairly favorable viewpoint for financial markets in the coming year. Obviously, interest rates are very low, so you're not going to get a lot of return from your bond market investments most likely. Although, interestingly, the bond market, the aggregate bond index returned about almost 9% last year because as interest rates came down during the year, bond prices went up and you got a remarkable total return there, really. And then again, we think corporations we were flat on earnings last year, but we think earnings growth will remain high. We're at historically high levels, and we think that we can maybe see some positive corporate earnings growth this year. So we have a fairly favorable outlook there. But with that, I'll stop there and are there any questions or any areas that the committee would like to take a deeper dive on?
Yeah, can you explain a little bit more about the valuations of the stock?
Yeah.
I'm just curious, are we saying that they're overvalued or properly valued, or?
Great question, Ralph. So on that line there, if you go over on 12/31 of 2019, the S&P 500 was trading at 18.2 times earnings. So that price earnings ratio is slightly above. Over to the far right there, you see the 25-year average at 16.3. So the way we would interpret that is the market is above its historical valuation level, but it's not dramatically above. So we're not particularly concerned. If we were like in the mid-20s on that would be more alarming to us. So, but that's a good question. So some overvaluation, but not significant.
Are you suspecting or any signals from the Fed are going to start increasing rates again?
Another great question. The Federal Reserve, the consensus viewpoint is the Fed will be on hold this year in terms of raising rates, and we would subscribe to that view. And the logic behind it is the election year coming up. The Fed wants to be seen as a non-player in all of that, and so they want to be as quiet as possible. So the most likely scenario is no Fed funds rate changes and in 2020 and into 2021, then maybe you start seeing the Fed thinking that they may raise rates. Our economic opinion is the Federal Reserve is in expansionary mode, and that actually rates are lower than they need to be in our opinion as a firm. But the Fed isn't calling us asking us what we think they should do.
We screen their calls.
Great questions. Other questions?
I'd just add on, maybe just on the Federal Reserve standpoint, they're very cryptic to some extent about the way they communicate, but they also try and get that message. And I think the message that comes from very clear the last year is they're going to err on the side of expansion or accommodation, than more so than they are. In other words, they'll be more slow to raise rates than they are going to be, hey, it's time to hurry and start ratcheting them up because it's getting too heated. So that seems to be a pretty common clear message that you're hearing from them. And then Bill, like you said, couple that with, they are wanting to be front and center for an election cycle, so trying to kind of stay out of the limelight and be quiet is, I think those two things make us think that you're gonna see not a lot coming from them.
So they don't want to hear a lot of tweets or read a lot of
Yeah.
tweets.
You know, I
They're the
would-
only ones.
Now that we're on that interest rate topic, I would, you know, the federal funds rate is the shorter end of the maturity structure. A comment about, the longer term interest rates may make sense. So, the 10-year treasury is trading at around, 1.5 to 1.6% in the last 2 or 3 weeks. We actually were knocking on the door of a 2% 10-year treasury rate, earlier in January. One reason why I mentioned that is if the economy continues to grow and if you happen to see CPI inflation get above 2%, we think you actually may see a steepening of the yield curve where longer rates start to tick up and shorter rates stay flat. The yield curve's, you know, very flat right now, but that would be an interesting to think. The interest rate scenario could be longer rates, may higher by the end of the year, perhaps.
Yeah, it seems like the likelihood of anything that could negatively influence the market is not going to happen between now and the end of the year.
Yeah, with that, the caveat of just that kind of unforeseen geopolitical event.
Right.
You know, first it was the situation in the Middle East with Iran in the fourth quarter, which again ended up not being that impactful. Now we've got the coronavirus, but you know, there could be something that could come along geopolitical kind of out of the blue that could maybe be more concerning to the market. So we would put that in as one of a possible scenario. You know, those are always possible.
Sure.
But
I just have one more question, and I'm curious about, you know, the recession risk. What do those numbers mean, really?
well, those numbers are, that's the leading economic indicators numbers. And the LEI is another thing you hear. The conference board comes up with these numbers. And essentially what the numbers are saying, it doesn't really, you know, it needs to be interpreted, so thanks for asking, is the outlook is very much like what we've talked about. Continued growth, modest growth, probably in the 2% range. The leading economic indicators looks at 10 different items that they feel like can point to, is the economy in a growth mode or is it in a contracting mode? And the numbers listed there just, you know, show if it's moving higher or if it's moving lower, but that's where we are right now.
It's kind of a scoring system of kind of the indicators that are above it. So that leading indicators, it takes all of those components and then it kind of scores them. So we watch that closely because it's kind of saying, hey, how are all of these things working together within the economy? And those numbers there essentially they're telling us, hey, it's a pretty strong level and we're seeing it hold at pretty strong levels without a lot of risk to weakness that might be coming.
Thanks.
Okay, thanks, Bill. We'll jump in here. If we go to page 36, just a quick overview of the assets in each plan. And then we've got just a couple of managers that we'll take a few minutes on to go through. And so if we look at page 36, you can see we always run this based on the previous year and then this year. And part of what we're looking for there is just asset allocation changes. Make sure that there's not big dramatic swings happening in your plan. You know, you don't have participants that are all getting together and deciding to go to Bitcoin or something like that. But so we look at this, we kind of look at the attribution. Obviously, you'll see that the plan growth is pretty significant. That obviously denotes the 401A merger that happened in the 401K plan. And then I alluded to this earlier, but you can see the current weighted expense ratio of 0.47%. About a year ago, it was sitting at 0.54. So when you look at those collectives and some of those changes that we made, you can see those, the amount of savings that came from those. And then, of course, the 457 plan below, you'll see some good growth in that one. In terms of and we'll look at those in just a minute in terms of the managers and the investments in the plan. But again, you see the same thing, current weighted expense there of 0.42 versus 0.53. And that in large part being driven by the collectives that were kind of put in place from this last year. So if we turn to page 38, it's a quick summary of the criteria that we have in the investment policy statement. And it's just a quick refresher, the investment policy statement that we have for the plan. It's in the back half of this packet. It sets forth all the criteria that the investments in your plan have to meet to stay in your plan. And I know we've talked about this, but we certainly at Soltis, we think good, stringent. We are in the camp of you want to have good, stringent. You want to have tough criteria. We want to have good investments in there. So essentially, in your plan, the investments have to be in the top third of their peer group and or beating their passive benchmark. So two pretty high bars that we're looking at very closely, and they have to meet that. And then looking at page 39 is basically a rundown of each one of the investments broken down by how many investments are in each. And we've got just a couple to report on. So you know, on a positive note, everything that's got two green check marks next to it, it means it's meeting that top third criteria and or passive benchmark, you know, that we're looking at. So every single option in the plan. So right now we only have two options that actually aren't meeting those metrics. We'll talk about Metropolitan West first. They've actually rebounded quite well, and then we'll talk about the Invesco Growth and Income. We actually do have a recommendation there. That's been a manager we've been watching for a while. There's been a departure there as of December. The kind of the lead portfolio manager we'll go to and talk about that. But Bill, do you want to maybe just dive in on Metropolitan West and each of those real quick?
So if you look at the Metropolitan West on page 41, we are not recommending any changes here, and I think it can kind of boil down to a few factors. One is, if you look at the bar graph on the left side of the chart, Prudential did beat its benchmark in 2019. It was up 8.9%. The benchmark was up 8.7%. So 0.2% may not seem like that much, but that's a pretty good result in the fixed income world. Metropolitan West does have kind of middle range performance for the 3 and 5 year number. So that is what puts them on quantitative watch. But if you look in the middle box, the quartile rank box, you'll see the 10-year number. They still are a top quartile manager. All of the managers who, there's been no turnover in the management team. It's actually an amazingly sticky management team. They've all been on since inception. 3 of the 4 managers have been on since inception of this fund in 1997. So basically kind of what we're saying is you have this kind of barbell on performance. 1 year's been good, 10-year, their long-term track record continues to be very good. And the management team's in place. So we think this 3 and 5 year period is just a glitch. Every manager is going to have periods of underperformance. So we think it's reasonable to be patient on this manager.
When we do look, one of the reasons that our recommendations to not change this manager right now is even though they've had that 3 and 5 years a little tougher, when we look at them on a rolling month to month, they're still beating their benchmark about 63% of the time, and they're still outperforming the benchmark by about 0.68%. So even though they've had some missteps, they're still actually producing returns above and beyond that. And as Bill mentioned, good team that we think they'll continue to.
When I would add one other comment on is one of the reasons we like this manager is they tend to hold up really well in down difficult markets, and so that's what you want from your bond fund manager, and they held up better than many of their peers when times get tougher.
Yep. So our recommendation there is to that manager to not change that manager at this time, but to continue to have them on watch and continue to watch closely their performance. And it has been improving, as Bill mentioned, on the 1 year, and so obviously that's what we're looking for going forward. Questions there?
No, makes sense.
Okay, the second one is this Invesco Growth and Income. And what I would say on this one, and Bill can certainly weigh in as well, So this has been a good fund. Thomas Bastian's been the manager of this fund going back to 2003. He somewhat unexpectedly stepped away in December, so he's no longer the lead manager on the fund. And the fund in more recent years hasn't performed as strongly as it had back in the earlier years. And so this fund has been on watch. It's been one that we've kind of been patient with. But with Thomas stepping away, the other two managers have less than 5 years on this particular fund in their roles. And so that creates some concern for us. Not that they're not sharp or not that they're not good, bright people, but you've got a tenured manager stepping away, somewhat unexpected, and now you've got the two remaining that, you know, have less than 5 years of experience on this particular portfolio as we look at it. And so we are making a recommendation there to replace this fund with Bill Nygren and the Oakmark portfolio. And Bill knows that one really well, so I can let Bill kind of weigh in on that one.
Well, I think as we look at this chart here, again, look at the.
Page 43.
Yeah, stay there at 43, the graph. I mean, historically, Oakmark has been able to get better returns than the Invesco fund. You'll see they're in kind of, I think I would call that turquoise color. For example, last year they were up 27% with the Invesco fund up 25.8, but more telling, if you look at the 10-year, the Oakmark fund has averaged 12.4 versus a 10.7. So, you know, they've demonstrated an ability to outperform the existing manager and this value benchmark. Traditionally, Oakmark is measured against the S&P 500, but they are really lean towards valuation or a value type style in their stock selection. If you look at the quartile rank, again, Oakmark is another manager that's got a great long-term track record, a consistent management process, and no turnover. That's one of the areas that I think we're most concerned about is turnover in managers with the Invesco fund. And as Tyler indicated, it's a lot of places, if a manager is going to leave, they'll give a lot of lead time. This one's a situation that kind of came up out of the blue, so it was a bit of a surprise. In terms of Oakmark as a fund, they do tend to have strong active share, and what we mean by that is they're not. Some active managers will kind of mirror the benchmark and not take really, significant variations from the benchmark. Oakmark is just the opposite. One of the things that means is they're more likely to get outperformance over time, but the ride can be a little bit more volatile. They can have a bad year or a bad period, but over the long term, the outperformance comes with that a bit willingness to take a stance. For example, today they're overweight financial stocks, they're overweight energy stocks. Those are two areas that really have struggled in the last year to 18 months. I mean, energy's actually struggled for, longer than that. So that shows their contrarian nature. But it seems to us that that's the kind, this is the time when this manager's good to be buying. It's kind of like buy low, sell high type of concept. So that's a little bit more on the Oakmark fund. But
Yeah.
would you add any other?
I just add, I think Bill said it really well. Good manager. Bill Nygren is definitely not a benchmark. He's not as concerned about what the benchmark's doing. He's out there trying to be a pure investor. Like, these are good companies, I want to hold them. And Bill said it well. We're coming through about a year period of him where he's struggled a little bit. But historically, if we've held him for quite a long time. Since inception, the S&P's done about 6. He's done about 10. So his ability if you're willing to have that manager and have him for more than 2 or 3 years, typically his long term is very, very good.
And then again, I think it's important not only against the benchmark, but against the fund we're looking at. they've
Yeah.
got a better record.
Yep, yep, so. So our recommendation is replace Invesco Growth and Income with Oakmark.
How long have we held Invesco as one of our funds?
It's been in the plan since we've been on. I can tell you in terms of watch status, it just went on watch in September of last year, and that was, so from a number standpoint, it's actually been okay. The watch status comes with the lead manager leaving unexpectedly.
Okay. I just want to make sure it wasn't one of the ones we switched out last year.
Yeah, no.
Okay. I don't know why it sounded familiar to me, but I guess I was thinking of something else. Kelly, on your side, is there any issues with switching those funds on the Prudential side? Good question.
Do you want a motion then to make that recommendation?
Yeah, I do. I just want to make sure there's no more questions.
Do we know if is Invesco in the Arcadia? Is it part of the goal maker?
It is. It is. So this change would happen in the menu, and then it would happen in
The
Goalmaker.
goal maker as well.
I'm assuming Prudential today runs Goalmaker, so they take the funds that are in the menu and utilize that.
So maybe all the more reason to change.
Yeah. No,
We'll just, what we do, it's a little bit longer, period of time for us to send the letters because it does affect PBIA.
Yeah.
So it takes, sometimes it only takes 70 days, it takes more like 90 days because you gotta give a 45-day notice to the people that we're changing the fund that affects the PBIA. So that should be.
We're limbo, aren't we?
Yeah, nothing's gonna happen in those 3 months.
Can you just make sure you send me those?
Yeah.
because I don't-
Yep.
Spoken by the guy who's just graduating.
That's Dave.
I know.
So we just
Okay.
make the recommendation to the county commissioners.
Yeah,
They would
so,
make the final decision.
I guess I need a motion that we will, replace Invesco with Oakmark.
I'll make a motion when we do that with the recommendation to the county commission, at least for consideration.
Okay, do we have a second?
I'll second.
All those in favor say aye.
Aye.
Aye, and motion passes 6-0. We'll make that recommendation to the commission official.
Okay.
Yeah, you know what
So we'll just put everything in queue and then we of course wait for that approval. Okay. The last item, agenda item on the investment review, if there's none others, was just as I mentioned earlier, was a review of Goalmaker. And so if we go to, starting on page 18, we've got kind of the breakdown of Goalmaker. So would it be helpful for me to just kind of give a high-level overview of what Goalmaker is in your plan?
Sure.
Okay, so one of the things that we try and do in a plan is build an investment menu for all types of participants. You have participants that say, hey, I know what I'm doing, I want to go in and pick my funds, I'm going to build my own portfolio, I'm more than comfortable doing that. You have a far larger percent, usually more like a 70 to 80% of plan participants that kind of say, I don't know the investment world, I don't really want to know it, I don't have the time or the expertise to do that. And so they have what are called professionally managed portfolios that allow you to say, hey, as a participant, I want to opt into one of those. And so what Goalmaker is, it's a portfolio, a managed portfolio system that Prudential manages today. And what they do is a participant that goes in and says, hey, I want to do this, or I want help, it walks them through a series of questions to help determine what their risk level comfort is, how comfortable they are with equity risk, or how comfortable they are with downside, et cetera. And then it helps build a portfolio that is then managed by Prudential for them based on that participant's preferences. Okay, and so within Goalmaker, you'll have 3 risk levels that really kind of come out. You have conservative, moderate, and aggressive. And then you have multiple iterations within each of those categories to help fit the portfolio as close as they can to the participant. Okay, so as you look at those, you do that. Now these portfolios, Prudential they pull them together from the investment options in your plan menu. So they're not using a bunch of outside investments or different investments. They're using the very investments that are in your plan menu. So really, what Prudential's doing is they're taking these portfolios and they build the allocation, and they build the allocation in the portfolio, and they do that for the participants. Prudential has an option that's called Goal Maker and then Advisor Goal Maker. And what Advisor Goal Maker says is it allows Soltis, where Prudential can say, look, we don't want to manage these portfolios, or the plan may prefer that Soltis manages them, and then we actually drive the allocations in the portfolios. We go into Prudential's system, we manage all of that, we rebalance, we take managers out, we put them in, we make adjustments to the portfolios based on some of the economic data that Bill's talked about today as a committee, and we go through that. So it's Soltis driving the investment portfolios in Goal Maker as opposed to Prudential. So that's kind of the two options. So we've talked about this with the committee. This is a decision of the committee to look at this. So what we did is we just tried to help you look at whether or not you'd like us to run those, or whether you want to have Prudential to continue to run those. And so pages 19, 20, and 21, they kind of show you the different allocations of your current portfolios that are in Goal Maker, so that you can see those allocations and how Prudential has built those. And then starting on page 26, what we did is, so most of our plans that we have at Prudential, the plans have actually chosen us to run Goal Maker. So for most of our, I shouldn't say most of, all of our other plans, with the exception of Utah County, and that's fine, I don't mean to, but the other plans that we do this for, they have us run Goal Maker. So we have a couple of plans that basically have almost the identical investment menu that you all do. And so what we're able to do is we run those portfolios that we're running in that Goal Maker, and then help just draw an analysis and comparison. So on page 26, what you see there is that comparison of those Goal Maker portfolios that we're running on a 1, 3, and 5 year basis, and then for both the conservative, moderate, and aggressive. And so I'll just take you through that. Basically, every place that you see green indicates that the portfolios that we're running have a higher return number than Prudential's portfolios. And every place you see red is where Prudential has had a higher return number than we've had. So you can see on page 26 there, we've had pretty good success of having our portfolios perform pretty strongly over a 1, 3, and a 5 year period. And these are, by the way, these are real numbers that are coming from the Goal Maker that we're running. So these aren't hypothetical, these are actual return numbers that have been realized by clients as we run these portfolios. So on a 1 year, so what we did is we looked at that, we then show you the weighted average, and we just tried to grind it out for you. So on a 1 year, if you look at those portfolios and you look at the dollars that are in them today, the weighted average outperformance was about 1.84% for the last year. Okay, over a 3 year period, it was less so, but it was 0.36%. And then over a 5 year period, it was 0.39%. Okay, and then if you go down to page 27, what we've done is we've taken your actual dollars that are in Goal Maker, and then we've just run those numbers through the dollars so you can see in terms of not just percentage, but in terms of impact to dollars in the plan. So on that 1 year number, that 1.84% would have resulted in a 1.16 million better return numbers for your participants than the current. On the 3 year, it's 816,000, and on that 5 year, it's about 1.6 million. So, so we have the ability, and we're here today. We'd be more than happy to run this and run these portfolios for you. There is an additional cost to do it. So when we do this, we take on the liability. We take discretion of the portfolios. It's a form of investment advice that we're giving when we do it, because we're running the portfolios and doing that. And so, so our fee to take that on and do that would be 0.06%. So it's basically 6 basis points. And that fee would only be charged to those that are in Goal Maker, so only those people that are in the program are paying for that fee. So the whole plan doesn't bear that cost. And then it's a basis point fee because based on the value of the account. If you look today at your plan as a whole, or your plans as a whole, You have about 63 million in Goalmaker. And that would result, just from a fee standpoint, to give you guys, it'd be about $32,000 to $35,000 more in fee to us to run those portfolios. But, you know, part of what we're proposing is we think we can, the fee that we're gonna receive is gonna be more than made up in multiples by a little bit better performance. And that's, of course, not a guarantee, but that's what we think we can do.
Are these performance numbers up here, are these after deduction of your fees?
Yep.
So do you have the 6 basis point for all of your
So,
other plans?
so what we do is, the other plans that have these, the fee is, the other plans that have these numbers, they actually have a little bit higher fee than the 6 basis point, because they're a smaller plan. They're smaller plans, so the fee that you're seeing here is actually higher than that 6 basis point fee that would be on your plan.
So if there was a switch with regard to Prudential, would your fee have to increase if you lose? Do you receive any benefit from?
They don't charge
managing these
explicitly
funds?
for it.
Yeah, so this isn't really, so with Goalmaker, it's an asset allocation tool, right? So it's not competition.
Yeah.
With us trying to sell something versus you guys doing it. We offer this just as a standalone product to, offer that diversification within the asset allocation tool. We hire Morningstar to build the asset allocations
Yep.
for us, because we don't wanna be fiduciaries on the asset allocation,
Right.
because we're record keepers, right? So we built this product for the advisors, and I'll give you an example of another plan that I have. It's not always just the allocations, but it's what funds can also go
Yep.
inside of. So why you might see the standard, Goalmaker lagging behind an advisor's, Goalmaker is because they might think that they wanna put REITs in it, or they wanna put, maybe some passive funds in it. That, you know, we have to go to Morningstar and ask them if we can do it, and, because it's a tool. Where what Tyler's firm is gonna do is gonna really probably tweak it
Yep.
a little bit more, so the engine rev a little better. Would that be a good example?
I think really well said. So they'll have limitations. They'll say, hey, look, we want to use this particular fund, and you'll have them say, hey, we can't do it because it's got to fit in this box. And if it doesn't fit in that box perfectly, we're not going to use it. And we, as the advisor, we do take the fiduciary liability, so they'll say, yeah, you guys can go ahead and then make that direction. So we have more flexibility in the program than Prudential does, yeah.
Well, and so another good example is another plan that I advise at Goalmaker is that they have a very young demographic.
Yep.
And they don't necessarily want, as much exposure to the stable value.
Sure.
As what Morningstar might put in there. And so you can also change how much goes into each sleeve of the asset allocation versus what we can just give you kind of the boilerplate, what you have. You know, and again, we would just change it to offer the advisor Goalmaker, and then we turn it all over to them, and then they would just handle, they tell us before the meeting what they're rebalancing, what they're doing, what ones they're, you know, changing out, but it really won't matter much to
You
us.
don't care.
So is this going to affect everybody in Goalmaker, or is it?
Yes.
Okay, so it's not,
Because you either have to
not
choose
individual. Okay.
advisor, Goalmaker, or Prudentials.
Okay. So
And right now,
this
you're
would
using
be-
Prudentials, yeah.
Okay.
And it would be an explicit fee, so those that are in there would see, so, again, if you were to look at that, $35,000, the average of balance in Goalmaker is about $64,000, so you're talking about, it'd be a fee of about $30 a year. That would come out, quarter of that each quarter.
And you said you were up on Prudential by like, 182%, is that what I heard?
So it's, on page 26, you can see it, this is showing Soltis's Goalmaker portfolios with a plan that has a very similar investment lineup.
184. Okay.
So 1.84 on the 1 year, 0.36 on the 3 year, and 0.39 on the 5 year. And then you can see that on page 27, we've capped it out for you in terms of
And that's
what
net
that
of their
additional
fees, so
return
fees
means
are
in
contained.
dollars to your participants for better return.
And 0.06 is the cost, correct?
0.06, so 6
Okay.
basis points.
Interesting.
I think we should do
Think we
it.
should do it?
Yeah, so do I.
I'm leaning that way.
Is this something that should be discussed though in a closed meeting rather than this meeting?
I don't know what the rules are on that, actually.
I don't think
I'll
we
leave that to Dave.
need to.
I'm just saying, since Solstice is here, would
Well-
it be more appropriate to make it in to discuss it in the
And
closed
we're
meeting?
fine, yeah, we're fine either way.
Yeah, that's actually not a bad idea, Ralph, now that I think about it. So maybe we should adjourn to a closed meeting if you wanna.
Do you
make our
wanna
recommendations.
Move and have Kelly go through the prudential plan
Yeah.
report, and then we can
We
finish
could do the
at
closed
the end?
meeting last.
Okay.
Now, if we decided to go forward with it, I would probably ask you to come to our commission meeting
Yep.
if there were questions that you needed to field.
Absolutely.
So
That would
that,
just be a recommendation from us.
yeah,
Yep.
and then the commission can make the decision
Sure.
based upon,
And that's really probably the most appropriate way to do it, because we can't recommend us, us as the manager.
Right.
So it really is from the committee standpoint of, hey, you're choosing a manager of Prudential, and so we can go through those and go through that distinction. I think Kelly said it really well. I'm gonna steal some of your stuff, Kelly. Prudential does a good job, but they do a good job with it. And like she said, they're not really wanting to do asset allocation advice, so I think they've built it with the expectation that, like for other plans, the advisors really can step in and run that program a little bit differently.
now, would it look the same, to the customer?
Yeah,
to the-
so they're not gonna see, they won't see, now I know there's some iterations where, like, they could white label and have Soltis in there too, but I mean, your participants are gonna see Goalmaker, they're gonna know they're in Goalmaker, they're gonna have it. I'd say probably one of the key differences is, once they're in Goalmaker, when they call in, they may call Prudential, and Prudential will route them to us, because we can give investment advice. They'll say, hey, you're in Goalmaker, it's run by Soltis, let's get you to them, that's who you need to be talking to.
But they would see the fee, which they are not seeing now.
Well, today, there's not an explicit fee, so Prudential doesn't charge an explicit fee for that product, whereas when we begin to manage it, there is.
They would see that.
Yep.
That would be new to the
Yep.
participants.
And of course, if we switch to advisor Goalmaker, we'll do participant
Yeah.
communication to everybody that's in.
To let them know.
So kind of that letter, remember the letters we had last year with the boxes with the fees,
Yeah.
they'll see something like that. But again, we built this product for
Yeah.
advisors.
Yep.
They had told us that, they wanted to be able to have some more flexibility and to be able to, offer different, either investments and or allocations within different states. So we used like the FAC, which you're gonna
Yep.
be on, and the
Yep.
financial advisors on that board helped us build the advisor maker, so.
So one follow-up question, what would happen if Soltis were no longer the advisor for the county?
So if we were no longer on the plan, then you could revert back to Prudential. In other words, you could just say, hey, Prudential's gonna take the program back over, and/or if you hired a new advisor, they'd have the option to step in and be the advisor or not, if they can do it.
Would the same program be available to someone else? The same Prudential advisor?
Oh, yeah,
Yeah.
any advisor that works with Prudential can use either one.
Okay.
Yeah, it's not just an exclusive Soltis or Prudential.
When we notify, if we go this direction of the change, would we be allowed to show the increased potential on earnings in addition to the extra cost? Because that's really what sells it to me, is that you're more than offsetting that
Yeah.
cost by the returns, so.
So we have, I'm trying to think of, I mean, obviously, the numbers are accurate, they come right from Prudential system. So I don't see an issue with that, but I'm guessing that Prudential would probably say, they're not gonna get it from us. But these numbers are from, like, the numbers that you have here on page 27, they're right from Prudential system on our portfolios.
So how?
they calculate them.
How could we educate?
I think we could put together a supplemental communication that goes to participants that says, look, Goalmaker's getting an enhancement, we're gonna try and make this benefit even better, here's some of the things that you're gonna get
Okay,
with with the new Goalmaker, and to kind of explain, I think, those things, and I think be able to show that data and help make that case. And I would even make the argument of, we would probably be an advocate of, because it's the largest asset holding in your plan, of even coming on site and doing meetings specific to those in it, to help sure they know and understand it, so that
Yeah.
they know what they're in. And like everything in your plan, they can opt in or out of it at any point.
What?
it's just a little harder to opt out of Goalmaker. They'd either have to build their own or.
Yep.
that makes it a little tougher for a lot.
I mean, I think those that are in it, I mean, I'd say QDIA, like if they haven't even picked an investment, this is why it's your QDIA. Because then it takes them and says, hey, you didn't even pick anything, we're gonna actually put you in a portfolio. It's a pretty good, well-rounded, and somebody's watching it and managing it.
Right, right.
So I think it's a good option for most, I would say, for those that are in it, especially those that have defaulted. It's probably a great solution as opposed to having getting defaulted into, or pick one or two funds and, you know, kind of hope for the best.
How many employees did you say are already in Goldmaker?
So I have two.
700 and,
So there's two plans, right?
Uh-huh.
oh yeah,
I actually had the wrong plan when I looked at it, like, because I got it from the clock this morning, but, that was on page 43, is the big plan. So you've got 431 that are default investors with, it looks like, about $8 million, so it's smaller accounts, right, on the default investors. But then you've got, almost 48 million that are choosing to use Goalmaker. So if you think about those people that are choosing to use Goalmaker, and you've got almost a 2% ability to make two more percent, and I'm in Goalmaker. I wish somebody was doing that for me, I mean, I just don't. foresee it
we
being-
should talk, Kelly. We can help.
So I always call it my set it and forget it. So, I think it's a really good tool and I use it and I think if somebody can make it stronger and make it, like I said, just kind of rev the engine a little bit, I think it's a good choice for people, especially those people who are set in the conservative because they defaulted in, right? So they're in the conservative sleep. Tyler and his team would be able to take that conservative sleeve and with the younger people, maybe not have them be quite so over allocated, you know what I mean? Because they're young, that we can't do because we have one starting before us. So would that be a good example, Tyler?
Yep.
Is that we've got all these young people that are in and they're all sitting in this conservative sleeve.
Yep.
You could say, well, anybody under 35, we don't want them to be in 40% stable value.
Yep.
Does it make sense, right?
Yep.
So,
Maybe a different way to say, Morningstar's great, I mean, they're a leader, but, and I used to work for a large pension consultant, there's a conservative bent always in their drive because of lawsuits. They're worried about, hey, if we underperform big time or we lag big time, we can get sued, so a lot of times they'll build in some pretty good cushion.
Challenged numerous times
Yeah.
as trying to say that we're a fiduciary because of the
Yeah,
default maker. And it's either been most of the time it's dismissed.
Yeah.
when we go into a lawsuit. Because we hire Morningstar, because we have a third party administrator, because we let them completely make the decisions of whether or not we change any of the asset allocation sleeves or any of the funds that are eligible. We just let them tell us
Yeah.
what we're doing and that's that. So that's how we've been able to say it's a tool, right? So I think what Tyler's offering is more advice than what we can give.
Okay, thank you. Let's move it along.
Closed session, right?
Yeah, did you want to go through yours first, Kelly, before we go to the closed?
Yeah, that's what I was gonna say,
Yeah.
we've got Kelly's portion, then if, we can take a few minutes on the education.
Okay.
Great, so everybody has the book. Tyler, do you have the book?
I did, thank you.
Seems, thicker than last time. No?
We heard those two plans,
Oh,
I wanna make sure we got to what we're
okay, okay, we're getting our money's worth.
Right,
Extra thick book.
well, I did the, we call it the saddle stitch instead of the.
Oh.
line.
Oh, yeah, it looks
So the
good.
pages are a little heavier. So why don't we go ahead and start on page 11, We're talking about the combined plans, and, I have Carol on, I don't know if she can hear real well about what's going on, but I wanna just address the reallocation that occurred.
Yeah.
So the reallocation occurred at the end of 2019, I wanna say like the 27th of the month. But because it fell over the weekend and the holiday, we actually did the reallocation. We didn't pull the funds till like the 6th of January. So I don't know, there were some days in there where we just went to 8, right? We went ahead and reallocated, gave everybody, so it showed up in 2019.
Hmm.
Then we paid and then we pulled it from the account. Does that make sense?
Yep.
So that reallocation was, $297,000, $75, leaving a balance in the plan of approximately $180,000.
Okay, and that's on the 401K plan, correct?
That's the 401K.
Okay.
Carol, can you hear me? That's correct, that's the So what she's saying is that the 457 plan did reflect in 2019, both for the reallocation and for the, coming out of the account. It's just the 401K.
Okay.
And what was the, how much was reallocated out of 457, Carol? 53,260.
Okay. And is that showing on statements now, do you know, on the statements that just came out?
They should be showing on the
Okay.
January statement.
Okay. So have you looked at yours?
Questions on that?
Nope.
Dave, you got any questions? We made sure we cleared that up before we got.
No.
If you wanna turn to page 17, we'll talk just quickly some historical overall numbers. We go from 1/1 of 16 to 12/31 of 19. This is for the 401K plan. Obviously, the plan has grown, from 85.5 to $100 million over 4 years. We know that some of that came from the merger that we did last year. Contributions have been pretty steady across the years, except we did have a little more because, again, that's those contributions that were probably going into the 401A are now coming into the pay. Same thing with distributions. Distributions jumped quite a bit, however, I think the 401A has a little bit more distribution in it than the pay necessarily
Sure.
did. So that's why I don't think it's that meaningful from a standpoint of, it happening all the time, but people that wanted to get their money out of the 401A, I think that's why we had that big $4 million jump. We'll have to keep an eye on it and see if we end up having negative cash flow, but I doubt that that's what's gonna happen. I think it had more to do with all the education we did around it, and people deciding, maybe I'll just take it. Okay? And then you can see what it did to our average account balance though. It went from $70,000 in 2016, and it jumped up to over 108,000. So by putting those two plans together, tells us that there were some larger balances in that 8 plan. And it really, went ahead and, jumped the amount of average account balance that we have. We do have to remember there's 2 plans in that account, so it might skew the numbers a little. But, a lot of people have the same people as well, that have those dollars in both plans. Our participation rate has stayed right around 80%. It did drop a little bit this year, and that's why I was kind of hoping maybe in our bi-weekly meeting, we can talk about whether it makes sense to look at doing a baseline re-enrollment. And I'll discuss that a little bit more when we get to that page, but basically what a baseline re-enrollment is basically grabbing, those people who have either never enrolled, which should be many of them, because of automatic enrollment, or those who decided to go down to 0. A lot of our, plans that do that, they know that, a lot of them go down to 0 because they don't know exactly what's going on, or they've had some issues with financial needs, then they never go back to it. And I think for the years that I've, attended the benefits fair, and I'm sure that Soltis has heard, people say, oh, I just forgot to put my amount back up, right? And, it's just something that we kind of have to stay diligent on.
And we can, target those employees, right?
Yes, oh yeah, we can only do that to the people who are So if you turn to page 25, you'll see of the people that we would target. There's a grid here, and it shows you that we have 7.4%.
What, Dave
of those
Shawcroft?
participating are at zero. So we've got about 7, 10, 11, well, 13% are under the 6.2% on page 25. So what we would do is we would just go grab them, right? We
Okay.
would give them like a 60-day notice and say, hey, if you don't, you have this window to opt out, kind of like when you automatically enroll, and you just grab them. You say you're gonna be enrolled unless you tell us to opt out before this date. And then what we can do is do a campaign around it, reminding people why, you know, they're automatically enrolled in 6.2 because of the offset. I still think there's a lot of people that don't understand.
And they can opt out before, so they opt out before or at any point after. So none of this is where people are locked in. So if it's, hey, I'm upset, you should come in there, well, work yourself out. It's the auto enroll.
Right.
If you do that re-enrollment, they've got the option anytime, if nobody's gonna be locked in. And the day that they don't wanna be in, they go right in.
Would we be able to, I mean, can you think of a scenario where we could get these folks, you know, together in a room and give them some live, you know, training?
Tell us who they are and you tell them
before.
they have to go to this meeting and
Yeah,
we're here.
I was just thinking we lock them in the room and we don't let them leave until they reach 6.2%.
So,
Yeah.
so we've had good success in doing that. I'd say there's two things you can do. One, if you can get them, target those people, get them in the room, and then two, make it very easy for when they leave the room to say, yeah, go ahead. So we've actually done this with Prudential in the past, where target those people, go to that room, and they sit down and they all have a form, and we take them through and explain and just say, hey, if this is good and you want to be in the plan, just go ahead and sign that form and hand it in. And that's something I'll be careful there, because I know when you get to manual forms and stuff, it's more work on Prudential's part. But we've done that in the past, and we've had between about a 60 to 80% opt-in rate that's come from that, from those
like
that attend. And that'll move the needle for sure.
Yeah, I just think it's, just from everything that I've heard over the years I've been at the benefits fair, there just is a lot of questions surrounding,
Yeah.
you know, either they get their social security statement and realize they're not getting anything, or they have gone down to zero and don't understand that if they would have worked for Frito-Lay, they would be getting that social security.
Well, I think last meeting I mentioned that my intent is to have 6 months after hire a reorientation to 401k and you know, retirement
Yeah.
plans. We're just hiring an analyst that'll help us with that, so hopefully we'll be able to get that going too. Because you're right, there's a lot of the new employees, it's just too much information, and they
Yep.
really don't get it.
And I just see it going down a little bit. I
Yeah.
know that when I started the plan, it was well over, it was closer to 90. When we
Mm.
brought the plan back in like 2011, I think you guys came back to Prudential. And so I've just seen it kind of go down, down, down. It might make more sense to do it before it gets too low.
Yeah.
Because then again, there is some cost to it, right? Because you're gonna be, you know, that 6%. So you probably budget for 100%.
We do.
So money's there
Yep.
theoretically to just go ahead and make sure people, you know, have the dollars and are able to meet the match.
Okay.
So,
Yeah, let's make a plan.
Okay,
It-
well,
Does it make sense to maybe have a discussion again on the auto rate increase?
No.
No?
Tried a couple times, didn't go anywhere, so.
Yeah,
that's why I
that's-
thought the
that's-
re-enrollment might be,
Did it,
might be a
did
better
you,
choice.
did we discussed it since we changed the commissioner and it still didn't go anywhere?
Yes.
Okay.
Yeah, just.
I knew we'd talked
there's
about it, but I
just-
had never heard the results.
There's just not interest in it. The the answer I got was, I just don't wanna feel like they're holding people's hands or pushing them in any direction. Even though it's completely, you can opt out anytime, they really are more of the, you know, organic approach to people choosing what their contributions would be. So, as of right now, no.
What percent of your clients do it? Do you know off the top of your head?
My book of business,
Yeah.
I've got about 80%.
80% do
I'm a
it.
big proponent, so I work, in most of my advisors are big proponents.
We are as well.
I was just curious.
Inertia works for you or it works against you. So there's, in plan design, you can put things in place that it does it for them, and it's one of those where they'll look back and be like, I didn't even know I was doing that, but man, I'm sure glad I did.
Right, right.
With rare exception, and so, and at the same time, it's the other one, when they have to go, I mean, when you look at opt-out rates for auto-enroll, it doesn't matter what industry, what profession, it's about 10%.
And
So,
ours isn't even that high.
yeah.
Ours is 5%.
So it's not a matter of, well, it's, it's different if they're making less money or if they're blue collar versus white collar or whatever. It's
Well, it
just
was,
inertia.
it was around the end of last year, so I'll bring it up again when we go over, benefits for 2021.
I mean, one of the issues is most of the employees get a merit increase every year, and if they were to take just a portion of that and apply it
Well, and
to
you can,
percentage increase, then they probably won't miss it as much.
yeah. And of course, you can cap it, so you can just say, hey, it's gonna auto increase until it hits 10. At that
Yeah,
point,
we
it doesn't
we
auto
did
increase
last
anymore.
time, that was our proposal.
But,
Yeah.
but,
I actually have some plans, I have 2 plans right now that we put in 6 or 7 years ago, and they're hitting the cap. And there are people that would like to go higher. Or the company knows that they'd let it run if it could go to 15. And I saw in the Secure Act, now in the Secure Act, they are moving that safe harbor.
Yep.
So 2 of my plans are safe harbor that, allow, when you're safe harbor, you guys don't have to deal with it, but it basically keeps you out of having to do
Testing.
ACP and ADP testing,
Mm.
non-discrimination. And, they were upset that they couldn't go higher than 10, because they just knew that there was a large population of theirs that let it run from 5 to 10, would continue to let it run to 15, because again, inertia setting in. So we'll probably go back on those 2 plans and be amending, or making sure that we can up that amount to 15, and just keep letting it run for people. So, if there's, I'll ask Ralph, see if I can find any white papers.
Yeah, that'd be great.
And then maybe some other government entities that do it as well,
Okay,
that you might have some hand of the commissioner, just our opinions.
that'd be helpful.
yeah, and I just add, as always, we're more than happy to help be part of any type of conversation, given this is what we do every day, so if that's helpful, we're happy to, I mean, we come from a fiduciary standpoint, so there's not a conflict for us to say, hey, let's do this or not, but just looking at the plan and trying to make sure you're capturing and your participants get the best benefit they can.
Do you see a high percentage with your clients doing it as well?
We do. So, I mean, when auto enroll, those features came out, it took a little while, because you had the mentality of, hey, they're just putting me in stuff, and I didn't ever even ask to be put in there. So yeah, you had that a little bit. I'd say that's kind of gradually gone away. To
I
where I
can't-
think.
I can tell you, having worked at other organizations in Utah County, there's a lot of employees who don't want to be told what to do.
Yeah,
And I don't know why that is here, but it's more so here than other places. They
Yeah.
very much, when I say they, it's, anecdotal, but I just get a lot of feedback that no, don't mess with my stuff.
I think it's a very small vocal few.
Yeah, which may be the case.
yeah. And we do. We have some organizations that have looked at it. I mean, I'll be the first to say we have a great organization. They're very generous. But their executive committee will say, look, we're big believers in that you have to go take action to get a benefit. Nobody's gonna do it for you, so we're never gonna go to honor roll. And we understand that too. So I think it is a question of, hey, I think the adoptions become more, I think the paternalistic end of it has become a little bit more accepted over the years, but at the same time, you have to look at your plan and demographics in
Yeah.
it.
And it's not gonna be a problem with the new employees at
Yeah,
all.
yeah.
It's not.
Yeah.
It's our tenured, more senior folks who do not want.
Well, and you can do that in various, I mean, you can say, hey, we're gonna move to auto enroll, it's only gonna hit new people coming in. So you don't have to, it doesn't have to hit everybody. I mean, there's lots of different ways to do it.
You
I didn't say it's a
start
sheriff's
without
department.
it,
And maybe the other way.
Yeah.
out there,
Yeah.
People don't want your message.
then we'd have some numbers. People
Numbers.
actually opt in.
Yeah.
So-
I say personality.
Uh,
They-
In fact, everyone at this desk.
I think there's multiple ways in
Yeah.
which we can help those that are out there, because I'd say you probably have a fair amount that are kind of going, yeah, I just need help, and I get it, in that it's like, hey, don't tell me what to do. But I think there's probably a couple different options that we're talking about here that I think we could help target and find a way to improve. And
You know, I think the other thing, and not to drag this on, is that another organization I worked in, they started with the enrollment around 3 or something, and then they auto-enrolled up.
to
So we're
6.
starting at 6.2.
Yeah.
So it's already, it's higher than a lot of employees are already, comfortable with, because they want to do like 5.
Yep.
So I think
But it's
there's-
lower than what Social Security with it. They'd have to
That's
pay
true.
Social Security.
That's true. So I think that's just a little bit of it
Yep.
too, is
Yep.
we're starting higher.
You guys have some unique dynamics
Yeah,
for sure.
we do. But with all that being said, I'm in support of trying to do it again this year.
Yeah.
I'm totally fine with that.
Is there a way to target segments?
Uh,
Just do it for a certain segment of the group? not
Theoretically,
everybody?
yes.
They're not arrested.
I say we start with
Yeah.
the treasurer's office. It's just a thought. I don't know why.
Hey, we could
Yeah.
probably get 100% in my office. We're not that big.
So ERISA-based plans, if you, whatever you put in, you guys aren't ERISA-based, but just how other plans work, if you put it in, it's gotta be eligible for everybody. You don't fall under that purview, of course. So yes, theoretically, you could look at a design to do that.
I think
That-
we want to follow the ERISA
Yeah, look at
standards.
Dave
I do
Gates.
too.
Yeah.
It's defensible if something gets challenged.
I'm always with you on this.
Well,
Dave.
Think outside the box.
Follow ERISA.
there's also, there's
Those
also
guys are in court.
things that happen that come from that, so.
Except for on the part-time employees. We're not gonna follow it on that.
I was just thinking, to me, the biggest bang would be for the younger employees, because they'd have a lot longer for it to grow, and
Well,
and
those-
if they're the ones that don't fight it as much,
They don't.
I'd
They don't
love
know.
to see it,
They
at
don't know
least
better.
for them, if we couldn't do it for anybody else, but just a thought.
I think we can get I think we can get something going this year, I really
Yeah.
do. But I do want to first focus on the folks that are under 6.2 right now. And
Yep.
at least get them to re-enroll and get them up to 6.2.
Yeah, there's 297 people that aren't.
Yeah, that's
That's a big population.
it is, that's a crime.
Yeah, and I think, of that 297, I would venture to guess, more than half of them don't understand.
Yeah.
What that means to them.
I'd agree.
Okay. And the other thing I just would point out on that page, on page 25, is 60% of your population is 6.2. So that's kind of very telling, right?
Yep.
That they're there and they're staying there and they're not doing anything. They're staying at 6.2. So, that's just another stat that I wanted to point out. If we flip back to page 18, we'll just quickly go over some of the demographics of the plan. As of close last night, your plan was at 152.5 for the 401K and almost 24 million for the 457. So there was some growth there as well. We've got, I wanna save some time to talk about the, secure, technology area, so, there's just a couple more things that I wanted to point out was, we did have some growth in Roth from 2018, 2019, it's on page 19, halfway down on the left-hand side. We had, and I would probably give the credit to Soltis and some of their, individual meetings they're probably doing, 'cause
It comes up a lot.
yeah, it
So
jumped up a
I don't know
lot.
if we deserve credit, but it's a question. We try and bring it up because it comes up a lot when we meet with your participants.
Right, and so Roth isn't usually something people go out and you would see that kind of jump, so I would say that some of the individual work that's being done is helping some of those people that are eligible for Roth and for Roth, and it makes sense, so that was another nice piece I wanted to point out. Does anyone else have any questions on the demographics, because I wanna leave plenty of time to talk about how we handle cybersecurity,
Nope, good to go.
okay? So if you go to the back of your book, it doesn't have a page number, but it would be after page 106, maybe like 107.
So security can't even find it.
Looks
Impressive.
like the, so as you can, I'm sure imagine that we take cybersecurity and fraud very, very seriously at Prudential. One of the things that, that we as, even myself, we have to take a hour and a half training every year so that we know how things are handled what we can and can't do, what types of fraud is out there. And so a good example is, we're very careful about who can have access to people's social security numbers, right? So the reason, a lot of times, I'll pass you on to Carol when you send me an email, is because it might be participant driven, or it might have something to do with anything Carol needs to get out of the system. I don't have the ability to go into the system that houses all of the social security numbers and everybody's individual data, because there's really no reason for me to be in there, right? So I don't have access to the record keeping system itself. That's why we work with Carol, and that's the responsibility that she has. That's one level of data protection that we have, is that only those pertinent people who need to make manipulations to the system are eligible to have that access to that. So, we take care of data for over 20 million individuals. So we have something called predictive analysis. We use this technology to identify login attempts to accounts from suspicious IP addresses. So we are watching to make sure that, we see an account that has numerous times. Of course, we have all the protocols to lock them out, but we're also do some research on, what's that coming from and where are they trying to attack us from. We have enhanced our verification and multi-factor authentication. So a newly registered account person is restricted until they provide the registration code that currently we're mailing, so it's snail mail. We are working very diligently to get that email and or text like we get with Microsoft and the other ones, where you can do the second authentication. But currently, right now, they're gonna get it in the mail and they've gotta go on to access the website. We've also put another layer on for any of those types of, so if you get a loan, you get a distribution, you change an address, we also wanna send you another, and that one I do believe we can send by text, because you've already gone in and authenticated, your account. Because we also wanna make sure that people aren't, we have lots of that fraud where we have people getting people's addresses and changing the address and then turning around and cleaning out the accounts. It tends to happen more on our individual side with annuities and life insurance. But of course, we have it across the board for all of Prudential Financial. We do a lot of risk management. We are monitoring the dark web. We have people in our technology department that's their job, is to see, and we actually hire ethical hackers, right? So we not only have them monitoring the dark web, but we actually have them looking at, from a hacker perspective, how would we hack our system and where are we vulnerable? We have a whole information security team 24/7. We do monitoring, a lot of anti-malware solutions. We have whisper technology so that suspicious calls can be routed to trained representatives. They don't know that they're being routed that way. We've got a lot of ways to analyze voices of callers. We train our call center people to recognize if a person says they're 80 but they sound like they're 40 or 30. It happens, where they're finding those things out. We're very careful about our data. We don't sell our data. We prohibit data to be transferred. So an example with myself is I can only print at the office. So if there's something I want to print, unless it's a book like this, there's no data that can go on a thumb drive or have to print, or I could go somewhere, but then I have to be there when I print it and I have to take it with me. If that makes sense. So we're very careful about any data that can get taken out. Everything gets shredded. And we never take anybody's personal identification information out of the office at all. Dave, you had some specific questions. I do believe most of these are answered on this page. You had talked about the network security and penetration testing. That's all on here. Those are sorts of the things that we're doing all the time. We're testing our own system. The one question that you had that I had to kind of go a little bit deeper because it hasn't happened, but is when you talked about LastPass. some of
Right.
our technology people weren't exactly familiar, because that's an app.
Third party.
It's the third-party,
Password
Freedom
protection,
Password
yep.
protector. There's apps that are like that too.
Yep.
I have one that's for mine, because everybody has so many passwords. So basically what they told us was, because it's a third party, the standard would be, if we would cover that through a third party, really is no, because, but let me, so they had to explain it to me, because we don't want to cover people. How do we know that it was, unless we can prove that it was done through LastPass, and we can prove that somehow we were liable for that, we wouldn't necessarily cover it if it was a breach of LastPass, right?
Well, and
They have to be responsible for that. Does that make sense?
just to add, so we haven't found, there's not a provider that we know of right now that will offer the coverage if you're using a third party to access their system, because they don't have the ability to manage and know all of the
Know
third
how
party.
it got breached.
So almost all the largest providers, Fidelity, Prudential, JP Morgan, Empower, they all have this, make a participant whole if their system gets hacked. But if that participant is allowing a third party to access their site, and that through that third party is how a breach happens, then they don't. So that was part of, I think Dave's question came from, in our fiduciary training, we actually had this discussion with our clients of, hey, you know, if you use third party, because I think a lot of organizations use a third party password protected system, that they want to be aware of that with respect to their 401k account.
So what they wanted me to let you know though, is that we do take everything on a case-by-case basis. Because what we have found out, in situations of like hacked passwords or, you know, those types of things, is it ends up being someone that you know, like a stepchild or a grandchild or a nephew or somebody has gotten a hold of the password information, and that's how they've gotten into the account, because they have the password information. Those types of things will look, from each individual one, and depending on what was done and how it was done, we have, you know, stood behind those people when those things happen, when there's fraud. But it's a case-by-case basis, so we didn't wanna just say, no, we wouldn't, that's the bigger picture. When these types of things happen, they wanna make sure that it's not something through a third party, but really it's being breached either by a family member, or I see it all the time. It happens a lot in the defined benefit space, where people pass away and nobody tells them, and they're just cashing checks. So, we see it all the time, but, you know, just know that we'll work with you to make people whole, they've been, hacked or had, some fraudulent activity on their account.
Great, well, thanks for that information. You know, that answer with regard to the LastPass and third-party providers, that's the answer I was expecting that you were going to provide. But I think it's something that participants need to be aware of that, because their expectation is they're getting enhanced security when they use these other programs, when in fact they may be reducing the protection that they have ultimately from someone such as Prudential, because they are using a third party.
Right.
So it's kind of a false sense of security to some extent.
And then I think you had asked one other question that I don't know, so,
There was one with regard to encryption, including in transit and at rest, whether the data is encrypted at all stages.
data is encrypted at rest and while in transit over public networks. Data is not encrypted within Prudential's trusted network. So, when it's external, it would be, and when it's internal, it's not.
Okay, so that's the at-rest stage, I assume, is what that would be.
Well, at rest, maybe outside of our network. If it's inside of our trusted network, then we don't encrypt. Because I do know that when we send emails back and forth inside of our network, we don't have any encryption. But if it's sitting somewhere going outside, right? So you know, when we get your secure mail, sitting at rest, it's encrypted. Yeah, and I thought there was one other one about, So some of the fraud and how we manage accounts is at the bottom of the participant web, when you go in and you log into your account, it's at the bottom. Some of our security language, of the first page of the web.
Okay.
Too, if you wanna take a look at that. For each individual person. Does that make sense?
Yep, thanks for providing that.
Can I just add two things real quick? So just on the cybersecurity, I think for this committee to know, Soltis does not have any data on your plan that we house or comes from us. Everything that we access on your plan is through Prudential. So we do that, one, because it's already cyber secure and our access point is the same as like you guys. And then two is to make sure that we don't have risk. So basically, anytime we sit down with a participant or take a phone call and they want to talk about their account, it's always through Prudential's site where we're accessing that information. And that's to make sure that we protect these as we do it. So there's no Utah County plan information that resides on Soltis's system and on our networks, which all of our machines and things are encrypted anyway. But I just want to communicate that to the committee. And then the second thing is our access as the advisor. We can log in and see participants' accounts, but we can never transact. So we don't have any ability to actually ever change anything in an account, which we don't want, and I'm sure you don't either. But just to, again, just kind of communicating to the committee, we access the data through Prudential's site, and then our access does not have any ability to change or transact anything.
So you can access, if somebody's coming to consult with you, you can access their account so they can see it while they're talking to you.
Yep.
Can't make any changes or anything.
Correct. So we prefer when they come and we'll say, hey, can you log in? Because if they do want to make a change and they're logged in, we can help them and they can make that change.
But do they log in on your computer or do you make them bring their own?
Well, so they can log in on our computer. There's the two-factor authentication, so we tell them you gotta have your phone with you, because it's gonna send you a text, because this is not your computer. So, but that's a way to authenticate and make sure that they're doing that, but yeah. We'll have participants every now and then say, hey, can you just make that change for us? And the answer is always no.
And then I don't know, is anybody, using the app, the Prudential app for your accounts? Or is it upgrading it? If you have it, well, get it on Play Store, because you might actually look at your account once in a while. I look at it way more now that it's on my phone than I ever did logging in, so. If you haven't, just go out and put Prudential in, and you can log in right on your phone. Any other questions?
That's good. Okay, where are we at?
Education, we can finish there.
If we could back up a bit, I think we were gonna review and approve the expense budgets
Oh,
for the,
That's correct.
I just
Expense
prepared a
budget
draft
review.
document to look at.
Okay.
And some unknowns, I plugged in the number of participants, I don't know if those are accurate or not. The 1339 for the 401K and the 1312 for the 457. And then I had a question there. Prudential assesses their fee based on number of participants, but it's at the end of each quarter or beginning of each year, or do you know?
So, how we assess ours?
Yeah.
It's, every quarter in arrears. So, January to March 30th would be a quarter, and then like the second or third of the next month, we'll go and we'll take it for the quarter that has passed.
And is it based on number of participants at the beginning of each quarter?
Each person pays their own.
No, but, right, but if we have participants that join in during the quarter, are they assessed the quarterly fee, or it's just prorated from when they join?
On a daily basis.
I see. So it would fluctuate?
Yep.
But,
Fluctuate a little bit.
but probably not a lot. Well, one comment here, when I ran this down through these numbers, it looked like there's a deficit of a little over $14,000 in each account based upon our current fee that we're assessing. which I don't see that as a problem currently for the 401K because of the large balance that is currently there of about $165,000. That's just a rough number, but on the 401, 457, at the end of the year, the expectation is that there'd be about a balance of 23,000, which is not a very large reserve. So it looked like there probably would need to be an increase in the fee probably in 2021
Yeah, I would think so too.
for the 457, just to bump that up to where it's not running a deficit. I'd also note that with regard to the fees, the only fees I've included here, the prudential fee, which is fixed per participant, the SOLTIS fee, which is a fixed annual fee. I threw in just $1,500 for potential mailing fees. NAGDA fee, split between each plan.
Is that what it costs to register for NAGDA as a
That's my understanding,
Yeah,
it's
that's-
$600.
That's like the membership fee.
membership?
That's
That's the membership.
an annual membership, and then there's a fee to attend the conference.
And I have that down here also, the NAGDA conference expenses. I just estimated the $2,000 per attendee, which probably close, I would think.
Yeah.
And I just put down 3 board members. The thought there would be that we probably all don't need to go every year because of the cost that is incurred. But it's just,
I agree
just
with
what I,
that.
just what I threw in there.
I agree with that.
And then the spring training, I have in the budget for all 6 board members to attend, which may not happen, but that cost usually is just the housing, the motel room. Plus the mileage,
Right, right.
so.
This looks good. Do you, any of the plan fees, do you think we need to just, double check on the numbers on those? And did you get the rates from the amount of participants?
I just pulled participants off of, I think, the last report that I saw.
Oh, okay, okay.
So I don't know how, they're gonna vary a little bit, not a whole lot.
Yeah.
So are you talking about our $24 fee or is that what
Yeah,
you're talking about?
Yeah, it'd be per,
Well,
participant.
We have what they call a revenue cap on, right?
Uh-huh.
So if for whatever reason we don't pull enough to get the $24, we'll just invoice it to the county. So there isn't, do you know what I mean? So it's not like,
Well, that would only happen if we ran a deficit in our account,
Yeah.
right?
but you don't have.
So we won't, we just
Say that.
adjust our fees so
Yeah.
that doesn't happen.
I'm just wondering, since there isn't an equal number of participants in both plans, if we shouldn't split a lot of those expenses, by the percentage of, for example, 52% are in the 401K and 48% in the 457. Maybe from solstice down, should we split those by those percentages rather than, I know it's easier to do it 50-50, but.
Well, I thought of that, but then I think it's more justifiable to not do that because regardless of the number of participants, the same service has to be provided with regard to Soltis, even though Prudential is on I think the record keeper, you can tie that to an account, the expenses per account.
Right, easy.
But with regard to these other services, you have to have those services. And so I think it's actually easier to justify not dividing it by a percentage because each account has to have a advisor.
I can tell
That
you,
advice isn't tied to the number of accounts.
yeah, I can see that logic. I can also tell you that when we attend these, trainings, we do allocate it by the percent of participants in the plans, and that's why the 401K carries a higher.
That's the way we're paid
burden.
back, reimbursed, right?
Yeah, so, and I can see why that would be more effective for keeping the balances more in line is to allocate it that way, but you make a good point about the services. But that's how we currently do it when we pay the POs. We allocate it, based upon the number of, participants in the plans. so that there's a smaller percentage of, expense going to the 457,
Yeah.
just based upon, you know, the participants. So, I would probably rather to keep doing it that way, just, it might eliminate any problems with the 457 run, you know, running low.
Or delay it a little.
Yeah, but it's open to discussion. Any thoughts?
I think we should keep allocating the way we do things. Especially on these trainings. I get Dave's point as far as the, for example, the annual fees, the prudential consultants fees. I mean, what do we do currently on those?
We actually, I think we do the same thing.
We do it,
I think we allocate it based upon participants, apparently. I'm not
I would
100%,
say keep.
I'm not
keep
100%
doing
sure on
that.
that.
If that's what we've been doing, I would say it's.
Either of you have any expense plan, you know, best practices? you could share?
Consistency.
Let's,
So you have the option to say, hey, this is how we wanna pay it. I think just be consistent. So if you're looking at those fees, say, hey, we wanna make sure that we're doing, I think our only thought would be just do them all the same. That way you don't have the potential of, hey, this fee was bigger and you were doing it different than this one, or vice versa. So I think just looking at it saying, hey, this is how we do the fees across the plans. Whether it's a prudential fee, whether it's Soltis fee, whether it's,
We could do that just upon the number of accounts and number of participants, and just do that across the board. We do that with Soltis already. We could allocate, I mean, with Prudential already.
yeah, you can do it that way.
So we could just divide it, all the other costs and expenses the same way.
yeah.
You just take that annual fee and divide it by your, you can do
Yeah.
it that way.
I mean, I think I'm fine with that. It's not gonna be a large difference because we have close to the same.
Close to the same, yeah.
Yeah, that's true. It will be not a significant difference. When we had the 3 plans, it was more of a difference between
Yeah.
the 3. So this will make it a little better. So I mean, we're gonna use this as guidance, obviously, for 2020. How strict do we plan to be with this? I mean, we obviously don't wanna ever go over. And,
Like if you decided to send, four to NAGDA or something,
yeah.
before we're over the budget. Interesting.
I would think we have to come back to the committee for any modifications to this, but I mean, I don't, it is a budget, it's not a.
No penalties
strict-
attached.
You know, you may go over a little here and under a little there.
Looking for the legal fine print here. Okay, no, that's totally fine, I think. Do we wanna rework this, or just go ahead and just make a motion with the expectations of how we plan to do it? As a general idea, we need a budget, obviously, I fully support that, and we need to stay in line with the budget, so.
Are the numbers accurate as much as we can get?
They're pretty close. That's why I'm saying, I don't wanna,
If they
I don't
are,
wanna
then-
hold this as, you know, gospel, because it's not going to be exact. It's close.
And will fluctuate throughout the year based on.
Yeah, well, I mean, the number of participants alone changes, so
That'll
that,
change it.
Right.
That changes too.
And the expense account balance went down so much because we allocated money back
That's correct.
to
We,
the
you know, reallocated
Yeah.
funds back to the participants.
and that's why I'm using the January 31st balance for the projections of, is the deficit, instead of the January 1st, because of that large amount that came out after the first.
And just so you know, Mike, I have a lot of plans that do budget for
Yeah.
accounts, do account, expense account. And it is what it is, it's just to make sure that what your fees are going out, you're covering enough, charging participants enough. So it's a good best practice to do.
Oh, I agree. I think
Agreed.
I absolutely think we should do this.
Yep.
Just, I'm open for suggestions on how to, whether we approve this now, or whether we make a recommendation now, or whether we make some modifications to this.
Well, I would suggest we just approve it with the modification with regard to allocating the cost based upon the number.
Number of participants, yeah.
Perfect.
And then you'll send around that updated version afterwards.
I will, and if I could get an updated number of participants, I could plug those numbers in. It might end up being a little more accurate that way. So moved.
Second?
Carol, did you hear that? Can you get us an updated number of participants to Dave Shocker on both 401K and the,
457.
457, both plans, total employees? As of what date?
Current date. Just
Yes,
the
because-
most updated
yes,
sheet.
because they're talking
January
about
31st?
Yeah. January 31st is fine.
January 31st is when I gave them.
Okay, so we have a motion and a second to,
Can I ask a question?
Oh, please do.
Just an understanding question. So when I see deficit, like, how, has that happened in the past?
We haven't had a budget in the past.
and we've
we've had
changed,
that high
we've changed the way we're
balance.
collecting revenue.
Right, so
And
that's,
we've just done several different things this
so
year.
all of that together is what.
And I don't really see us having a deficit in reality and for the plans entirely. I mean, that's just my opinion, but
Do you think at the end of the year,
it is,
these numbers won't?
that's my opinion.
Well, we're still not running a deficit. It's just that we are spending more than what's coming in.
Right, and that's what I'm getting at.
And that's why my expectation is that a year from now, or at the end of this year probably, we need to look at those fees and
Reassess
adjust
where
them.
we're at.
Yep.
Which I definitely agree with that. I kinda wanna see how these numbers play out over the next year. Okay, that helps my understanding.
Okay, so we have a motion and a second to recommend, the adoption of this proposed budget, knowing that, these numbers, can change based upon, different, changes in expenses, participants throughout the year. And if there is any additional expense that needs to be considered, it needs to come before the committee. And I hope somebody wrote that down.
Mark, you
And-
got it.
And the numbers will be updated with the numbers that we get from Prudential, so they will change.
Yeah, the numbers will change.
And reallocated based upon number of participants.
Correct. And this will be our guideline for 2020 to stay within our budgeted expense account plans. So, sound good? Okay, you have all in favor?
Aye.
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 Me not in favor. Oh, aye. Motion passes 6-0.
It's a real good idea to have this, with all the changes that have been made.
Yeah, I do too. It's a good call. Thanks, Dave, for doing that. Appreciate it. Okay.
The Prudential specimen document utilization.
Oh, the 457 doc.
So,
I saw things.
so,
So I saw, what I saw is an invoice for the charge for the specimen document work for the 457. We're talking about the same thing?
Yeah.
Okay, but I haven't seen any work yet.
you saw an invoice?
Yeah. So I'm holding the invoice.
Carol, did you hear that?
I'm not paying it yet.
Carol?
Pay in advance, apparently.
That's a plan amendment.
Okay, let me,
Let's bi-weekly meeting now.
yeah, let's bi-weekly meeting
We're
that.
gonna
I'm
bi-weekly meeting.
pretty
now.
sure it was for the,
We'll look at
okay.
the invoice on the bi-weekly
All right.
meeting.
It's not in the
'Cause I
budget,
don't
so you
think
can't
we've
pay
done
it.
good enough. We're still
Sorry.
researching
Okay.
a couple of items for that. I think I did tell you the last meeting that the total cost moved to the specimen
Uh-huh.
document was $1,800.
Yeah, yeah.
But we're still researching a couple things to see from a prudential standpoint what makes sense. So we'll table that to the bi-weekly
Okay.
meeting. And then, but I think we had a couple different amendments, remember?
Yeah,
I think there were
and
two.
I might be wrong, it's just that when I asked about it, I was told that the ones that related to the 457 were not something we could expense because they weren't those types of expenses. They were
I think that's a settler expense.
Settler expense, thank
We need to
you.
change it so it wouldn't
Well,
come
yeah,
out
no
of this
plan
budget.
amendment should be paid
Yeah.
by expenses.
okay. Okay.
So we'll go over that.
Okay.
So that we make sure, you know, cause I didn't think we moved on that 457.
No, I hadn't heard we had either. So to answer the question, Dave, it's still in research.
So we know how much it will cost if we do it.
Correct. And we are planning on it, unless you guys find something that makes it so we can't do it.
Okay. Yeah, there's a couple of different things we're still looking at. Cause there's a couple of different documents floating around out there, because you were with us and left us and came back. So we're just trying to verify which document relates to which use. Does that make sense?
Absolutely.
Okay.
So we just need to use their specimen, we don't have to worry about it.
Right. Yeah, forget about our documents. They're no good.
Carol, did you have anything? Yeah. You guys realize that was settled. Yep. Anything else? Okay, I think we're good here at Prudential.
Oh, okay, sorry. I think we should go into our closed meeting. Hopefully no one's in a hurry to leave.
We can do this first.
I was thinking of doing that very last, but is that okay?
I don't care.
Okay. So Dave, how do I get us in the closed meeting?
I would move that we go into closed meeting to discuss professional competence of an individual or individuals. With today's date right now. This
Okay.
place.
Okay, do we have a second? All those in favor, aye.
Aye.
Aye. Motion carries 6-0. We'll move into closed session. Yeah, stop the recording. We'll just need like 5 minutes, and if you guys want to step out,